Hello, how is everybody doing this afternoon? My name is Gavin McGuire. I post on the briefing.com site under Event Trader, and I am joined today by Brett Manning, our Senior Market Analyst, and Sean Udall, Trader and Technology Sector Strategist for briefing.com. Sean posts under TECHT, of course, and Brett is Chart Trader, posted under Chart. Today we're just going to cover a couple of pertinent topics that are in the market that we thought would be useful for the users. We're going to do it in a roundtable style format to try to bring in a little bit more discussion. We got a lot to cover, so I'm just going to basically cut right to the chase. Our first topic that we're going to be looking at is whether or not the market is at a top, and Brett Manning is going to kick us off with his look.
Thank you, Gav. Hopefully we've got the slides lined up right. So, hi guys. Now, when I look at this question, we talked about this webinar and the most compelling topics, and I think that this is something that's still constantly on everybody's mind. And that right there is an important point, because generally speaking, in a market cycle, you don't really have a tremendous amount of speculation on a top at the top. And there's a lot of sentiment data that suggests that's exactly what's consistently going on with every move higher that we make in the market, which is a strange situation. But what I'm thinking about here when I consider this question is, let's look at this chart, right? This is the S&P 500 for the market cycle. I'm going to answer the question, or at least talk about the question of whether or not this chart is at a top, just to simplify the question. So the market cycle in U.S. large caps in terms of the average price. So the first thing I want to is that it looks like an 8+ year straight up trending move. But if you look at the types of things that I look at, that's very misleading. This chart is kind of a lie, because there's a period in there marked by those two red arrows that really changes everything. It looks like there's no bear market in there as far as the price of stocks, but there's actually, when you look at things like investment flows across asset classes and sentiment data cycle, there's a bear market. There's a very clear bear market. It's kind of a strange situation. The two red arrows indicate a period with some massive outflows, really kind of consistently, from equity mutual funds and equity ETFs into bond mutual funds and bond ETFs. And we had a kind of broken cycle where half the market was really getting crushed and half the economy was really getting crushed because of what happened with the commodity side and the materials and the heavy industrials. So I think of that period as kind of like an important break. And one way to conceptualize why that happened is, and this is an example I kind of touched on in my last webinar, but if you think of like imagine a rubber ducky floating in a bathtub, and the rubber ducky is basically the level of the market. And the faucet is cyclical flows coming in, and the drain is cyclical flows coming out. So at a certain point here at the beginning, at the first red arrow, the faucet was off and the drain plug was pulled. Money just started to pour out from retail investors, from institutional long-only, equity-only managers. The allocation went to 15-year high in cash, and just week after week after week of equity outflows, bond inflows during that entire period. However, because at the same time that pushed interest rates down into negative territory, even out to like 10 years in Germany and Japan, that skewed the whole sort of global financial world into a very odd place. And a lot of it has to do with what central banks were doing. But a lot of it is also just this dynamic of there kind of being this deflationary pressure and people shifting money over into bond funds. A lot of the money that's sort of natively involved in fixed income investments, trillions of dollars around the world, was forced with an allocation problem where they're guaranteed a negative return if they move their capital into those markets. So if you imagine that bathtub, it's kind of like if you've got hoses over the side of the tub, kind of making up for the water flowing out of the drain. You've got money coming in from things like sovereign wealth funds, pension funds, insurance companies, endowment funds, where they have to get some kind of return, and they can't put their money into something that guarantees them a negative yield. So that really sort of distorts this chart. And we had, for all practical purposes, a bear market come and go without having the sort of creative destruction of changing valuations. But the money flows happened. The sentiment cycle happened. All the money that's normally cyclically involved in equities came pouring out, and now it's coming pouring back in. So this chart kind of is a difficult thing to perceive right. And the reason why I think what we're seeing right now is so aggressive is because we're seeing that baton pass back over to more typical money flows involved in equities on the cyclical side. Now, if we're looking at this sort of adjunct extra bull market, which is kind of, I think, the right way to think of it, it's probably not going to be quite as powerful as the first bull market of this cycle, because we didn't have that resetting of valuations, but it still needs to sort of run its course. And for me, running its course has to do with sentiment data. You need to get to a place where you've crossed that spectrum again, where you've gotten to the point where people have made assumptions about what it means to be involved in equities that allow for there to be enough accumulated risk to get a top, because that's what a top is really made of. It's built of these assumptions. When money flows into the equities market have become aggressive enough for the market to be sort of out over its skis, leaning too hard. And you see that in the sort of sentiment data measures that I typically look at. And what I'd be looking for here is some sign that people are making an aggressive kind of potent allocation to stocks all the way across the board, including retail. And you're going to see some of these measures shift dramatically when that's the case. Right now, we do not see it. We have not gotten to the point, despite how it seems like the market has just flown higher, we have not gotten to the point where we are seeing a lot of evidence of people just being really excited about being involved in the stock market. Things like, just last week, we had an American Association of Individual Investors survey, which basically asks people, is the market going to be higher or lower 6 months from now? And it was one of the most aggressive week-to-week moves back toward it's going to be lower that we've seen in a long time. And that's after this run we've seen. So that sense of just assuming that every little pullback is a great buying opportunity and that you really can't get hurt being in stocks, we just aren't seeing it. So I think it's possible. I think we need to get there first before you start talking about a real top coming in. I think we're going to need to see some period like that, and we haven't seen that yet. I do think that there's one caveat here, and that is those hoses hanging over the side of the bathtub are probably not there now because interest rates have moved relatively dramatically. So you don't have that same, tremendous safety net sitting there. So once we do get there, there's going to be some real risk involved in the market. And I think it's just possible that after we clear some of the political risk in Europe, you're going to start to see some of that excitement come in. We get past some of these big risk factors looming over things, the big macro risks, and we start to see like an open blue sky where macro factors are concerned. And, wherever the market gets to on that, possibly with a solid next quarter earnings, wherever on that, you're probably going to see some of these sentiment measures shift, and there's probably going to become some better opportunities on the short side. But right now, it's a really tricky prospect. So that's what I have on that, and I will pass it over.
All right, this is Gavin, event trader. Again, I'll be just presenting my look at the market right here. So basically, we had that big little burst right after President Trump gave his joint session speech. We hit 2,400, but we're never able to get above that level, and we kind of pulled back to 2,360. So I'm going to show you a chart here in a second, but what I'm looking at in the short term here is a little bouncing back and forth, a little consolidating between the 2,360 level and 2,400. We could fall in between those areas and, drop a little bit further, maybe see a little peek ahead. But I'm looking for us to kind of stay in that level and consolidate over the next month or two. There's a couple of questions that are out there. One being obviously the European geopolitical issues. The second being with the Fed going, which really has me keeping a close eye on this 260 level in the 10-year. I think that's really key for where we could start seeing flows from equities into bonds and vice versa. The other thing that we're going to have to keep a close eye on here is, of course, the new administration and whether or not they're able to get through their policies. President Trump has noted the cost of health care, and that really seems to be a bottleneck in terms of getting anything done with taxes or with any infrastructure spending. So I just think we're kind of in a little bit of a pause mode. But to answer the question, if I think we've hit a top, the answer to that's definitely no. Right here, again, is that chart that I was looking at, and this is kind of the box where I'm looking at as a possible consolidation area over the next month or two. But I think once some of these headline risks have passed, that I think, as Brett said, there's a lot of money that's sitting on the sidelines that's ready to be put to work here, and sentiment has not nearly hit an extreme. So I'm looking for that to kind of kick us off and get us to a final leg over the summer. Here is the 10-year yield that I was talking about with the 260 level, and you can kind of see that inflection point of, if we're able to get over that, then you could see bonds running and pushing a little bit higher, and that could definitely be a drag. But I'm looking for 260 to hold in. That's why I liked Brett yesterday on the site had a long TLT or long ZB bond futures, which I definitely agree with, because I'm looking for that yield to hold in, which is another reason why I think that we have yet to hit a top. A lot of people are looking at the valuation of the markets, and rightly so, and we are at very extreme levels. The price to sales stands above 2.08 times, which is the highest that I could find since 1963. I couldn't find any data before that. We never even reached 2 times price to sales in 2000 or 2007. Price to earnings, which is obviously something people talk about a lot, over 20 times at the moment. And the number could even be a little bit uglier if we're to look in at the $2.1 trillion in buybacks since 2012, which is approximately 10% of the market cap. And since 2010, you could even look at an approximate 30% difference between GAAP and non-GAAP earnings, which, basically brings down the quality of those earnings. But again, valuations are not an effective timing tool as we've seen in the past. Here's a couple of quotes that I just took off from Bernard Baruch and John Maynard Keynes, where it discusses about the psychology that's behind and the overcrowding of a trade and how the market can remain irrational for a lot longer. And I think that we have yet to see those extremes in sentiment, and I'm kind of looking for that to push us higher. What I am going to be looking at is towards the end of the year in September, when just something that I came across when I was doing my election webinars, where the last 14 recessions since 1928 have happened in presidential years. Or the last 14, 11 of them, or 79%, have happened after elections. And that is because policies that were expected to go through all of a sudden hit a roadblock. And that's going to be something that I'm really going to be keeping an eye out on. But I think sometime during the summer is when you're going to see us hit fresh highs and see a nice little rally that has people scratching their heads and talking a little bit more about whether or not we've hit a top. Now, with that, I'm going to pass it along to Sean for his view of the markets here.
Hey, everybody. So again, Sean Udall. This to me is one of the more interesting charts. And first of all, I want to say I think both the guys did a great job in front of me. There's 2 things I'd add to the prior commentary before I get to this. One, that price to sales number, I'm assuming that is market cap. It's a market cap weighted number. On an equal weighted basis, I know it's far, far lower. So in my mind, what we're struggling with, I think what everybody's struggling with, is we kind of have a tale of 2 markets. We have the market that is the S&P and the NASDAQ and the Dow, which has pretty much been led, I think something like 94 to 95% of the performance of the market has been roughly 8 to 10 stocks the last number of years. So, we have lots and lots, hundreds of thousands of stocks not participating. And Brett brought up a very, very interesting point about where the indices didn't really print a bear market, although I think officially in 2011 we did. I'm pretty sure we were down 20%. I know the NASDAQ was down 25% plus in 2011, and yet nobody kind of wants to call 2011 a bear market. So in my mind, some way you might want to restart the clock of a new bull market really off of 2011 instead of 2009. But here's a major structural thing that I've always seen with extended markets and markets that fool people and tend to go higher. What we're looking here is a CRB. This is a monthly chart. I think it only goes back to like the late 90s on this. But if you just look at the action, so you get a major correction in the CRB, which is largely oil. I think everybody agreed that oil tends to drive the CRB. So you get a big move higher, That's part of a bull market cycle. And then you actually get a huge, almost a crash effect in the CRB. Sometimes that coincides with an interim bear market. Occasionally that coincides with sort of a major bear market, as it did in 2008 and 9. But what we're seeing here is, if you look at just the absolute crash type level of the CRB and how little it's gained in the last few years, that would portend to me to be that there could be a lot of room in the S&P 500, the NASDAQ, and especially the average stock. So I'm just saying, keep in mind of the CRB, and I don't know if I can ever recall a significant market top, both in price, in enthusiasm and sentiment, without the CRB index sort of fully participating. And you can see right here, I mean, CRB is still kind of at rock bottom. It's on the floor, and the S&P's been grinding higher. So that's one thing I would point out. So this is the NASI. Basically, this is a summation index of the McClellan oscillator. This is basically taking, okay, what's the average stock doing? How many stocks are going up versus how many stocks are going down? So it kind of looks like here. So if you look at basically early 2014, we basically had, in my view, this has been the interim cyclical top of the current bull market. I actually think we've been in a stealth bear market since that peak right there in early 2014. And what's happened since then? We had a biotech shakedown / mini crash in 14. We had the oil market completely implode. Then we sort of had the average stock had a major correction in 2015 and 16. And again, we all know what the biotech sector did. I think the average biotech stock went down 50, 60%, average oil stock down 60, 70%. So there again, Brett alluded to this. I think we kind of had a bear market, not kind of, we did, but the indices didn't print it. Here's a longer view. Okay, so now this is, if you kind of look at the action, this is very, very telling since 2008 and 9. And this basically kind of shows you what the bulk of the average stocks are doing since 2008 and 9 low. So we all know what the S&P chart looks like. It looks like that on the bottom, which is a nice glide path higher. And this has sort of been, I think, the performance of the average stock, really. So whatever you want to say, we have not had any enthusiasm at all for the bulk of the stocks. The average stock has not done well. And I mean, if you go back and look at historical charts, they just don't look anything like this when you're at a market top. When you're in a market top, again, you have a look like this, where you have a NASI that's way high, that's had a big slope up and a move higher. And again, this sort of interim high here, it almost looks deceiving when you compare it with a view like that. And that's about all I have to say on that. But I tend to agree with everybody else. I would kind of say that price to sales ratio, while relevant, is probably heavily skewed because of market cap weightings. Anyway, on to the next.
Good stuff. I mean, so I would, just to recap on that, I'm guessing all three of us are in agreement that we have yet to hit the top. Would that be fair?
Yes, yeah. Especially for the average stock.
Okay, so we'll be expanding upon this a lot on the site, and this is something, if there's enough interest out there, that we could always turn back around to and just run a webinar specifically on this topic, because obviously it's something hot and people are going to want to continue to discuss it. But for the most part, I would say that we're pretty comfortable still here at these levels. Sure, there could be some gyration, some headline volatility, but I think a press higher seems to be in the cards from our point of view. Taking a look at some of the other topics, the next one we're going to move on to is French elections, and this is something I'm going to comb through pretty quickly, just kind of laying out some of the details, and then I'm going to ask the guys for their thoughts on it and any plays that they're seeing, because this is going to create some volatility over the next month and a half now that we got the Fed out of the way. So this is something we wanted to touch upon. Now, with that, we, of course, had the Dutch elections last night, which turned out to be a pretty big positive for the markets. Geert Wilders' party did not do nearly as well as some people had thought, which actually tends to be the norm for him. He usually underperforms in national elections. And some pro-European parties were able to outperform. So that really brought a sense that this recent wave of populism and nationality might not be spreading through to Europe, which is obviously important, as that's 27 nations trying to work off of a single economy, basically. So the French elections are the next one up, which, of course, we've heard a lot about in the news. Just to give you some of the logistics, the first round's April 23rd. That's all the candidates that are running. So basically what you're going to do is have votes split across 5 different parties. Right now, polls are showing Marine Le Pen and Emmanuel Macron winning the first round. So what happens after that, and actually Le Pen they show leading in the latest polls, but a recent survey just showed her at the lowest percentage of being able to win the presidency. But as we've seen with polls from 2016, they're not to be relied upon. This is going to be the first time a socialist or Republican party have not held power since 1958, if this runoff does indeed occur. So it's going to shake up French politics a little bit. The second round will be held about 2 weeks later on May 7th. Where it's, if it is the Le Pen versus Macron runoff, it's basically a classical liberal versus populist fight going on. Polls currently have Macron leading at 65 to 35%. I wouldn't believe that. I think it's going to be a lot closer. I don't think Le Pen's going to win, but I do think that it's going to have people nervous enough that they're going to be keeping a close eye on it. There's been a lot of questions on the polls, and it seems like Le Pen's base is stronger than Macron's, so it's tough to kind of extrapolate numbers from it. But here's something to keep in mind with that race. Legislative elections are about a month later on June 11th and 18th. That's basically 577 seats that are up for election in the National Assembly. Think of that kind of as Congress. So, currently the National Front, which is Le Pen's party, has 2 seats of those 577. Socialists, which is Hollande's party, hold 288. You can look at that as an offshoot of from Macron, who was in the party with Hollande. And then Republicans hold 189 seats, which is Fillon. If an opposition gets a majority, then the president and the assembly must cohabitate. It's happened 3 times since 1958, and basically nobody's had pleasant memories. It's more or less gridlock that could be expected in the French parliament. So if people are comparing Le Pen to Trump, but the difference in that theory is that Trump was able to take the House and the Senate with the Republicans as well. Le Pen stands little chance of gaining any complete control over it. Therefore, is going to have little chance of pushing through a lot of her reforms. Actually, the same could be said for Macron's En Marche party, but he'll have a little bit more of a background as he's more center and as the backing of the socialists. So basically, the National Assembly can force no confidence votes in the government, so we could be looking back at elections a couple months later, and they can, importantly, approve or block referendums. This is okay. This is perfect for, Le Pen, who's looking to hold a referendum on whether or not France wants to stay in the euro. Again, this kind of runs down some of the rules from the French elections on referendums. There's been one time where a president was able to force through a referendum. That was back in 1962 with Charles de Gaulle. He had the backing of winning World War II. However you want to view that, the French people certainly viewed him as a champion in that cause. So Le Pen is not working with that same sort of collateral in her pocket. Now, there is a potential for a 2-month window for her to call a referendum, but it's an extremely difficult road. Then there's also an Article 16 that provides extraordinary powers, which, is something she could try to invoke, but that would simply cause a revolt, in my opinion. So the key with the French elections is whether or not France would go into default on their debt. With Le Pen forcing France to leave the euro currency. Here's some of the numbers. There's $2 trillion of French public debt out there. under French law. There's $240 billion in corporate, and there's $340 billion in financial debt, all in euros. Important to note, the S&P has said that a decision to fund in another currency would not necessarily be a default. So think of it, if they decided to try to pay off some of their debt in, French franc or whatever new currency could come about, that's going to cause a lot of consternation, but not necessarily a default. And some of the differences in this is how the CDSs were written in 2003 versus 2014. This is another topic that I'll discuss a little bit more thoroughly on the site. But this is going to be something to keep in mind, and it's kind of leading up to where are the opportunities, and this I'm going to want Brett and Sean to chime in on. Basically, how I see it is I'm looking at some of the fears in Le Pen getting in and France completely changing course as being overdone. So I'm really looking at a long in the euro. We've been discussing this on the site for a little while, as well as the EUFN long that I've had on there in Deutsche Bank. I think you're going to see a lot of people seeing some of the valuations in the U.S. markets being high and moving more money over to emerging markets and it's Europe in particular, as there's a lot of value there potentially, especially if you believe some of these worries are overblown. The last thing I have down there is a new currency. The general thought is if Greece leaves, if France leaves, that they're going back to their drachma, they're going back to the franc. I disagree. I think that they're going to look to move forward and kind of look at what India did with, them taking the $1,000 bills and $500 bills out of circulation and moving more towards a digital economy, which really has me looking at and loving some potential blockchain plays once they come in. And that's some of the things that I'm going to be looking at as opportunities. Now, Sean or Brett, if you guys want to jump in here and see what you're looking at in this setup, I'd definitely appreciate it.
Yeah, sure. I will. This is Brett. I'll jump in real quick, and then you can go, Sean. One big point that I want to add to what Gavin just said, and it was an extraordinarily good summary of the situation and all of the dynamics involved. But one sort of more conceptual aspect to the situation, I think it comes down to, as far as the trade and whether or not there's an extraordinary trading opportunity here, I think that comes down to a couple things. And the main thing is the degree to which, as we get closer to election night, the market has to start to assign something even close to near even odds. And not just polling, because as Gavin brought up, I think that there's sort of a PTSD dynamic here because of what we went through with Brexit and Trump, where people who are managing tremendously large amounts of money aren't necessarily going to think that polls that show, a decent percentage difference between the two as you head toward that second round election are necessarily something that they can have that much risk on. So there's 2 points, right? One is the degree to which you have to, if you're managing a large amount of capital, you have to assign some kind of realistic chance to Le Pen. And the other is the degree to which you agree with this idea, and this is what I think, and that is that the Brexit referendum is the election. There are a lot of different barriers to accomplishing an exit. I think the resounding win for Le Pen, or something that's solid, that appears like a mandate, what we've seen is it's very tough for politicians to actually then fight against something like that. We saw it with Brexit. There were a lot of different opportunities for people to try to reconceptualize what happened in the Brexit vote and find a different version of it. But even politicians there in the UK who were steadfastly against Brexit have fallen in line and supported this process, because it's really hard when you get a big vote like that that comes decisively in a direction by everybody in the country. Politicians tend to then, for whatever reason, whether it's self-interest or a sense of some kind of moral basis for their career or whatever, they tend to kind of generally move in that direction. And I think there's no question, if you're voting for Le Pen, you're voting for an exit. So whether or not there are legislative obstacles, I think the market will stop concerning itself with that idea. I think you have to start looking at the concept of France leaving the European Union on some level if Le Pen wins. We're not sure the details. We're not sure exactly how that's going to proceed, but you have to start to take that seriously. And to me, to have to hedge about that possibility coming right up into that election night, and this is the point about whether or not the odds seem like anything close to even when you get close to that election, for big money managers, you're hedging against something, whether you conceptualize it as a default or not. The deal with the EU is it's a three-legged stool. And the UK wasn't in the euro currency, but they were one of those legs of the stool. They were one of the supportive economies in an economic arrangement. And it's Germany, France, and the UK that were the legs of the stool. And it's Southern Europe that's sitting on top of the stool, right? And you see that with the bond spreads. Whenever there's a risk of something happening like this, the spreads widen out a lot because Italy's debt is not viable at its current interest rate set. There's no way that reflects true risk of Italian economic default risk, anything else. That is because it's sitting on that stool. If France leaves, it's a one-legged stool. And that one leg is going to get awfully concerned about having to support the whole thing because it's going to mean they're sending money outside of their country in one form or another to support people that they see as being profligate. And that's in front of their own election. So I think the stool doesn't work anymore at that point. Now, personally, I believe there's no chance Le Pen is going to win. I just believe that the fact that we've had this process of watching Brexit and Trump means that people are going to over-assume that chance. And therein lies the opportunity for the big trade. And the big trade, Gavin outlined a number of possibilities here. But if the polls start to show Macron getting to where he's massively ahead coming into the election and people realize continental Europe is not the same as the UK or the US, which it's not, then this trade maybe isn't there. This opportunity maybe isn't there. And we have to be realistic about assessing that. But if it looks like you have to take that very seriously, and that implies that stool breaking, then there's going to be a huge opportunity if we really believe deep down that Le Pen is probably not going to win. Then suddenly you're left with probably the most pro-business leader of France in a couple decades, even in Macron. Fillon would have been even better from that standpoint, just from the standpoint of a pro-business shift in policy. But Macron is still, practically Ronald Reagan or Margaret Thatcher compared to Hollande. And that type of flip-flop over one night, where you go from having this huge risk of possibly like an Italian default coming up to more unity in Europe and the most pro-business France, and that stool back together more than it's been in a long time, is a huge volatility event that's easy to see in terms of its directional implications. So I think kind of looking at that conceptual set is important. Sean, I don't know if you have anything to add to that.
I'm just going to add one thing because the something in the markets have changed in roughly the last 3 weeks. And what I mean by that is again, the indices are holding in, not much of a correction, but lots of stocks, hundreds of stocks have had, again, one of these kind of stealth corrections, kind of mini stealth bear market. So there's something out there that is causing a de-risking of what I believe is fairly large money. And because the one thing these guys aren't going to do is they're not going to wait 3 days ahead of something like this and try to de-risk billions of dollars or hedge billions of dollars in a 3 or 4 day period of time. So my guess is the single thing David Tepper was on TV for 2 hours, and I kind of lost count how many times he mentioned that if France goes the right way, I feel really good. If France goes the wrong way, I'm going to lose my hiney. But, he mentioned the French elections probably double digits or more. So, again, something is out there. Something's causing people to pull in their horns a little bit. I think the media would say, oh, it's the market's high and valuations are high and people are selling stocks because they're high. Well, if you think about it, the average stock really isn't high. Facebook is high. FANG stocks are high. A stock we're going to talk about in a little bit is pretty high. But the bottom line is the average stock isn't, but yet people are de-risking kind of everything. So that's the only thing I think is worthwhile to add on this is that I think the thing that is, if there is sort of a de-risking pulse in the market, which I firmly believe there is, I think it's because of the French elections.
All right. Fantastic, guys. Fantastic. We're going to move on to our next piece here. It's going to be kind of a quick interlude before we jump back into the macro, and then we'll finish up with some picks that we're looking at. But the next section that we're moving on to here is basically tools to identify big trades. So, Brett, you're going to start us off with this one.
You got it, Gav. Okay, so if you've seen a couple webinars ago from me, you've actually seen a slide very much like this, and it's really my answer to this question. And I think that I've got probably quite a different approach than you're going to hear from the other two guys, and I'm sure that their ideas are fantastic. But this is something I think that people don't normally think about, so I want it to be kind of my 2 cents on this. Basic point is maximize odds of having. It's kind of a framing for being involved in markets, right? Systems that get you closer to that type of outcome. Maximum odds of something in with high conviction, so you can let it really make some money for you. And it turns out to be right, and you don't have to take unnecessary risk. And I think that if you follow this step, this set of steps, you get to where you basically have something that's a framework for doing that. And the first premise here, the first idea is falsifiability. And I think it should be your first filter. To me, it's a large sample of trading opportunities. If you always have this be your first filter, then you're really starting the game in a great place. And the point with falsifiability is identify setups in terms of how easy it is to know quickly that you're wrong. If you go into something already with a conception of what it is, if you see it, it's wrong. You know, identify X when X equals that trade is wrong, whatever it is. But have a sense of what falsifies the setup. And if you do that, right there, you basically filter out and eliminate all potential for catastrophic losses. And if you don't do this, you know, you end up with a situation. Let's say somebody is shorting the market right now. They're saying these valuation numbers, they're terrible. I'm getting short the market. Well, it's not a falsifiable setup objectively, because if the market goes higher, valuations are probably even worse, right? And every step higher, your setup gets better and better and better. And if the market's just in a straight up run, markets can do things that you don't believe are reasonable. You got to start with that premise. Let's say the market just goes straight up, wipe your account out, because every single step up, that setup is better. So you started with a setup that's not falsifiable, and that brings into your sample of outcomes, the outcome distribution that enters that loss. So if you go forward with this premise, first thing, how do I know what's wrong? When you start with that, you eliminate from that sample catastrophic losses. And the next thing, I think for big trades, identifying big trades is thematic logic. And basically, I conceptualize this as thinking around the next corner, right? Basically, position, we'll talk about this in a little bit, but your interest in the Treasuries is just crazy coming into the Fed hike. And, you know, that's for obvious reasons, that catalyst. And if you start thinking a day before that about what's just around that corner, and what we just talked about with France is a perfect example, money's going to be coming out of the, most likely, out of the French bond market quite rapidly. And will it go to Germany, who might bear the brunt of having the responsibility to assign value to Italy's bond market? I mean, there's going to be spread widener trades put on there, but there's going to be a lot of cross-Atlantic fixed income flows. I think we can, I mean, unless Macron just starts to run away with it, that's what you have around the next corner. So you got a Fed hike, and then right around the next corner, we start looking at cross-Atlantic fixed income flows coming over from Europe, most likely. So that kind of sets up that, well, let's start looking at what that means for Treasuries. It's just around the corner. So that thematic logic allows you to think like that. So that's part of it. Larger pattern and mode is just taking into account the trend, right? Basically, what the market seems to be doing. If it's a bad headline, does it hold up well? Good example of this, if you look at Mexico right now. Look at the EWW, you look at the Mexican peso. Anytime bad news comes out, it goes down a little bit and then blasts higher. Like, that's the mode it's in right now. And if you don't ever fight that, you're starting from a good spot. Don't come up with setups where you're fighting kind of this undercurrent of what the market seems to want to do. And then sentiment situation, you hear me talk about this all the time. It's very important to keep it on your radar. If there's a consensus about something, you don't want to trade with that consensus, generally speaking. It's not an easy opportunity. Otherwise, sentiment data is not that important. If it's middle of the ground, it's important to know that it's middle road, but that doesn't mean that it necessarily points to a trade. However, when there is some kind of big consensus, when there's some kind of extreme in sentiment data, it becomes the most important data point because it identifies a positioning thing, a crowd leaning. And it's important to know what you're going into is a crowd. Okay, so, and then the short-term technical trigger, the last point, I usually identify this. We had a line across the NASDAQ futures yesterday morning in front of the Fed, basically saying, this is the trigger, 5,400 and above. We've had, you see the way that I post these, basically with either a sloped line or a flat line trigger, a level that's either breaking a trend in the direction of a longer term trend or breaking a level in an assigned breakout. That's kind of the point where you become more heavily involved in the trade. So those 5 things are the elements that I use to identify a big trade. I want it to meet each one of those criteria kind of down the line. So with that, I will throw it over to Gavin.
All right. I'd approach this a little bit different. I was just looking to point out some of the tools that I use to people. So I'll just run down mine. I mean, basically, I got the basic daily routine of just coming in and checking all the futures, seeing what's shaking out and, what possible news is out there. I do my day ahead comment, which is meant to capture basically all the news that was out overnight and then some of the key items that's going to be coming on in the U.S. markets. And a lot of it's just built off of looking at these charts as soon as I get in. More on a micro front, earnings previews, I do a lot of those for the website, and I just find them to be very therapeutic because it's always interesting to see how a stock trades right around the earnings. There could be certainly one-time events that cause more volatility and everything. But a lot of the times I find that earnings kind of hits a reset for a stock and opens up opportunities. So, I try to identify that within the previews. Just not to self-promote here a little bit, but the briefing.com archives for doing research on stocks, guys, is really fantastic. So I highly recommend people going through and using that as much as possible. Then just, I use MarketQ for my charting software, and I use IB for my accounts. I know we get a lot of questions on that from people. So, they're just basically some of the tools that I use. Now I'm going to pass over to Sean, and he's going to break down this QCOM chart for you guys.
Yeah, so I'm probably going to go maybe the most detailed on this as far as like how I really get into a setup. So I'm not going to say I ignore the market. I'm definitely in tune with the market. Hey, where's valuation? Where's sentiment? In fact, I'm a huge sentiment sort of scorer, if you will, and look at a lot of things. But what really drives me is trying to figure out what a company's worth relative to other companies. And then once I've done that, rank them. And once I've done that, then I got to figure out what is the price that I want to enter the trade and exit the trade. Okay. So I have Qualcomm up here for a very good reason. It's my single favorite large cap tech stock right now. Apple used to be, at one point Google used to be. There were a few others, but right here, right now, Qualcomm, single favorite large cap tech idea, period. And so what is one of the bases of that? Well, if you were to value Qualcomm at the same price to sales ratio of Avago, guess what? It's a double. It's literally that simple. So if Qualcomm can trade at the same price to sales ratio of Avago, Qualcomm's trading at a 50% discount to Avago. So in my mind, one of two things is going to happen, or three. One, Avago's trading too high, which, by the way, I don't really think, but Avago's trading too high and is going to come down. Two, Qualcomm's way too cheap and is going to go up and meet something closer to Avago's valuation, which I think it will. Or three, they'll meet in the middle. Qualcomm comes up, Avago comes down, and they meet at a relative valuation. And literally, that's kind of how I look at almost every single stock. I rank at least a couple hundred companies against each other, if not more. Have a really, really, 40 to 80 stocks, which I really go deep in. And then when it comes to timing the trade, sometimes I think people just ignore really simple tools that are out there for everybody. Those simple tools are things like the MACD, the ADX, the technical indicators that you can get on free services. And then the other one, I love EMAs, exponential moving averages. And on this chart, it's hard to see, but I have a 5, 20, 50, 100. But the one thing I've really learned not to do, especially the last 2 years, if a stock is below a 5 EMA and still descending, I'm very, very careful about buying it, even if I think the valuation is unbelievably great. once that stock gets at or close to a 5 EMA, my willingness to buy it increases almost exponentially. Same thing, 10, 20. Now, once it gets to a 50 or 100 or 200 EMA, whatever. But I have to kind of go back to my fundamentals. But I would encourage everybody to really just put put a 5, 10, 20, and 100 EMA on a chart and go through 50 or 100 charts and look at them. And then the last 2 points I'll make on this, again, MACD is an excellent tool. I think it's massively underutilized. But if you just look at Qualcomm, now you can barely kind of see like a really, really good value buy at the very beginning of that chart. Again, you could have missed the first 5, 7, 8% of that, still got a great entry around, let's say, $44, $45. So there, your MACD is rising nicely, going up. Then Qualcomm, what does it do? Goes into kind of a sideways consolidation pattern. Your MACD flattens out. Not much is going on. Boom, there's an earnings gap higher. You kind of wonder, oh boy, do I buy the gap up? Well, guess what? Look at the MACD. Stays above the zero line, keeps going. Anyway, I could talk technicals for an hour. I'm not going to deal. But if you just kind of look at some charts like this, look at some technical indicators, and just look at what they do. I think a lot of people, overthink them. By the way, look at the last sell-off in Qualcomm. You can say, well, man, how was I going to get out of Qualcomm before that big tail, that big drop? Well, you know what? If you just sold Qualcomm when it was basically kind of at or going below the zero line, you got out of that stock at a pretty good price. And you were out of that easily 2, 3, 4 weeks before the big earnings decline on that stock. So I don't know. I think a lot of people try to mystify technical analysis too much instead of just looking very clearly at what some good technical indicators are. And from that, I'll pass it on.
All right, good stuff, guys. Thanks a lot. Then we're just going to move on to our next topic here, which is China, and Brett Manning is going to be leading the discussion here.
Yeah, okay, thanks, Gab. I want to go pretty quickly over this, but I want to present a situation that I think is going to be a really, really important process working itself through in the second half of this year, the first half of next year. So I want to really quickly outline what the situation is. There has been a problem identified in China in the pulling of the banks. It's understood pretty well, especially in the hedge fund community. There are some massive bets against the renminbi, basically because the analysis suggests that the only way out of this situation, that it's impossible to avoid, eventually devaluing the currency, recapitalizing the banks, and taking a huge loss cycle, writing off all of those debts. It's ridiculous to think that those are sustainable debts. Those are realistic balance sheets. So a lot of people know this, and it's interesting to look how China's tried to deal with it. Be essentially China about it at this point, especially in Xi Jinping's more kind of nationalist understanding of China. Basically, what they've done is they've said, we're not going to devalue, we're not going to take the loss cycle, we're not going to recap the banks. They're going through a process that I think is kind of like, the story about the little old woman who swallowed the fly, and then she swallows the spider to catch the fly, and then she swallows the bird to catch the spider. They keep on kind of tacking on extra measures to try and balance the situation. And the situation is most easily defined by where a Chinese billionaire is going to put his money. Right now, there's this force to get the money out of China, because if they're going to take a pen in Beijing and stroke off 20% of the value of those savings, then people who have a lot of money in China want to get their money out. So that's sort of, and the spider is the capital controls. Let's go ahead and put a fence up around the whole country so no money can get out. But that ruins confidence around the world and internally. So now they've got to find a way to lure capital in, right, to stabilize the system, because they know they need to get rid of these capital controls without having to devalue the currency, recap the banks, take the loss cycle, et cetera. So they've come up with an interesting extra measure recently, which kind of exposes maybe what the strategy is here, and that is to allow a whole new set of currency hedging tools to foreign investors. So basically, you can use FX boards and all sorts of measures to try to take away the risk of a devaluation if you're a foreigner with lots of money, which gives you an incentive to say, hey, maybe the assets in China are undervalued. And if you take away this whole dynamic, the assets in China are massively undervalued. And the question is whether or not there's going to be this sort of tumultuous outcome, or if there's going to be some kind of a soft landing and smooth elevation out of this. And the most important thing coming up here, I think, is whether or not China will be added to the global bond indexes. And if you introduce these this ability to hedge the currency risk, we've already got Barclays and Bloomberg talking about doing this, and it could happen. There could be later this year. If that happens, the interesting thing that happens then, economies in the world suddenly admitted into this, it's going to be a huge weighting in the global bond index. It's also going to probably have the best yield of any of the big weightings in the bond index. So if you're a bond fund manager, you have to put your money into it. And that's possibly trillions of dollars pouring into China. And that might be enough for them to take away the capital controls. And this whole thing kind of shifts psychologically. And right now, as I understand it, you've got the China A-shares market, which would be next up to be included in the MSCI index, and it's trading at about a 7 PE. And you've got a ton of growth there, and you've got one of the biggest economies in the world, and one of the biggest stock markets in the world, and one of the biggest bond markets in the world, and everything has this kind of barrier around it that's kept people from taking risks on it at all. That is just the conversation. And there's a process in place here that could suddenly rejuvenate that whole kind of role of China as an interesting investment thesis. And that's, I think it's just, I would just want to get it on the radar, because at some point you either are or are not going to see this strategy they've put in place start to pay off for them. So there's a couple slides I have here on this, but the gist is basically something I've covered already. You can see at this point, we're already seeing the trade surplus boom again to its highest levels ever. So you're starting to see some of that soften as far as people believing that you know, they're basically just seeing all of the money just pour out of China and there being no sort of counterflow. This is as big a factor as the global bond fund index inclusion, but all of these together may kind of give them the ability to get out. And finally, I've got a chart that I used in my last webinar, which basically just shows you the outflows and inflows from the FXI ETF. And basically, since the middle of September, nobody has put their money into China, and it kind of gives us this sort of vacuum sense of things. So I don't know if you guys need to comment on this. If you want to run with it, go for it.
Yeah, I'll just add a couple of things here. And, you know, I thought Brett did a great job at, you know, kind of discussing what the issues are there. You know, obviously it's scaring a lot of people off when you start seeing China all of a sudden is now the largest banking system by assets with over 33 trillion in the market, as opposed to Europe, which is 31 trillion, and the U.S. 16 trillion. You know, the bank value is 3.1 times the size of the economy over there, and it scared a lot of people out, but we've also kind of seen sort of like a bottoming pattern there, which is what's intrigued me the most. You know, I know, Brett, we've discussed in the past the MSCI inclusion with the A shares. I don't see it happening this year myself when the determination's in May, but I do love that as a swing trade for the next 2 months, just kind of leading up into that. And I think also for longer term holders that this valuation that you could get it at right now might be the cheapest that you're going to see, because we've already seen some of the big guys like Jim Chano's coming out short China, and a lot of other big fund managers. And yet it's still been able to hold in there relatively steady despite all these headwinds. They're always going to have the credit overhang, but, you know, I completely would agree that some of these valuations here are pretty enticing to start looking around at. So, you know, that's basically all I'd add there. I mean, we could follow up with a discussion. I think China alone would be worth a webcast going down the road. But, Sean, do you have anything to add here?
You know, only thing, again, I don't do as much in China because I can't trust some of the financials as much. But there's been certain Chinese companies that have done very well, and Baidu being one, Alibaba being another one. In fact, I played Alibaba via Yahoo, you know, from kind of 2012, 2013. But if you just pull up any chart on China, I like the SSEC, or just whatever your symbol is for the Shanghai. And basically look at a weekly chart. It kind of looks like an emerging breakout. And FXI looks pretty good too. So daily chart, this is a great example too where maybe our market looks like daily chart looks kind of toppy on China, but if you zoom out or a weekly chart or a monthly chart, it doesn't really look that bad. It kind of looks like a breakout on a weekly chart. So I don't know. I personally won't want to be short China right now.
All right. Now we're going to bring you guys to a few ideas that we have moving forward here. Some buy and short candidates that we'll discuss. We're going to run through with Brett kicking off on his bond commentary here.
Okay, thanks, Gab. Just real quickly, so I got long Treasuries. I use the 30-year in the bond futures market, but you can use TLT. I'm not sure at this point I want to call this a high conviction idea right now. I think it's going to be, but I kind of touched earlier on the interesting dynamic. Falsifiability side, I think that any kind of big out again in interest rates takes me out of this trade because we're heading in front of a situation where I think that there's kind of hedging coming across from France, from Germany, from everywhere over in the EU in front of the French elections, and so honestly, it should not be a problem holding the trade that I'm currently in. So it's falsifiable at my current stop as far as I see it. Thematic logic, we talked about this earlier. If you got in it right in front of the Fed and you're looking around that corner, you know what you're walking into. We had a long conversation about the French elections and the risk they impose and the need for major hedges in place. I think that basically is all fuel for the Treasuries market right now, especially when you're looking at a crude oil market that's just corrected, close to 50% in just a few days. So the larger pattern and mode doesn't work here at this point. That's why I don't have much size in the trade. So this is really me just banging the table right now and buying Treasuries. But it's a good example to show my thought process and what I think is a good way to look at this sort of thing. I don't have a lot of size in it right now because it's a downtrend in bonds. Still, we may have some support, but right now, it still is a downtrend. And the sentiment situation works tremendously in its favor. As we noted earlier, it's a hugely crowded short in Treasuries from 5-year all the way out to the end of the curve right now in the futures market. It's very clearly the case. So the sentiment is good from the long side. The single trigger, again, wasn't there, really. There's not a pattern basis in that trade. It was a difficult trade to take from that standpoint, but it doesn't mean that it won't give me both signs on the mode and signs on the short-term trigger that allow me to now size up the trade tremendously. That, I think, is a very strong possibility, and you'll see my future commentary on that. But it's certainly something where I like having exposure to it at this point. With that, I'll kick it over to events.
All right. Actually, Sean, we got your slides coming up here. It looks like, hold on a second. Okay, never mind.
No, there
sorry,
you go.
Sean,
there you go.
Skip over there. All right, yeah, I'm just going to run down a couple of names I'm looking at. I'll be commenting a little bit more in depth on the site on some of these. One is the robotics ETF, Robo. It's just kind of bouncing up around that 30 area and everything, and it's looking a little toppy, kind of like the markets, but it's the future. There's 85 stocks in this. A lot of the companies are Japanese and Korean, which is why I haven't gone out on the site with a long just yet. I'm kind of hoping for a little bit of a pullback potentially. ROK would be a U.S. name that's got a high valuation in this. I just look at some of the numbers, and the U.S. right now operates 176 robots per 10,000 workers, which ranks it only 8th in the world. I just see some upside coming here between the U.S. and China spending more money on it. And then just taking a look at potential corporate tax cuts, which could lower operating expenses, but not labor. That's going to drive some more investment into this robotics area, and just simply kind of see it as the future. And ETF that it never hurts to squirrel away some money here for a longer-term portfolio. Mueller's MWA, which is a water play. I think we could wait for this to come back to us at 10. But I've been looking at a lot of the water ETFs as of late. But it's funny, they mostly are industrial heavy and really track the industrial sector more than a pure play water play, which is kind of what drew me to MWA. This was one of the best names I saw out there. But I'm just kind of watching it for now and see it coming back to 10, which is where I'm planning on pouncing on it. Overstock. This is an interesting name. It's a potential blockchain play, actually. I know everybody remembers the CEO with his Sith Lord comments about shorts out there on the markets, and they technically, are more in play with Wayfair and the likes there. But they've actually been at the forefront of this blockchain technology, which is going to work into India. It's already working its way into the banks. If France or Greece starts turning left, blockchain, I think, is going to be an area where more and more people are looking to. It's going to be the future for financial payments, and I'm looking to try to get some exposure to it. Most of the companies out there are private, but Overstock is actually talking about rolling out their fintech area into a pure blockchain play. So I'm keeping an eye on this going forward. NVIDIA is named that. Sean's going to give you an opposite take of it in a short while here, but I love this as a buy at 95. I just think that some of the spaces that they're in, robotics, autonomous driving, virtual reality, artificial intelligence, all these areas are just going to continually be big plays in the market, and I think that they're right at the center of it. And, I like that they're kind of expanding their revenue streams to data centers, which is their fastest growing area. So, I just think this is one of those names that, people are going to continue to look at valuation, much like they did at Amazon back in the day, and, Apple, Facebook, and everybody. And just if you're the leader in a hot area, I want to get in at a reasonable price. And I'm kind of looking at that 95 area as a price to get in. Sentiment changes and the market turns into the dumps, that could change this look. But that's just a name that I really like. And then gold, as been discussing on the site for the last couple of days here. I was waiting for that Fed event to get out. Covering it, unfortunately, kept me from putting a long on the site in it. But, I just think with some of the uncertainties around some of the French elections, I know somebody wrote in what would be a hedge for the European elections. I think gold's one area that people would be taking a look at. We're still seeing plenty of QE out there from the ECB and Bank of Japan, so I don't think there's any shortage there of asset purchases. And then we're also seeing the Fed tightening here at home, and a lot of that's due to a fear of not being in front of inflation. And I've just seen the inflation theme pick up, and I think it's going to pick up a lot more over the next 2-3 months. Just due to some of the year-over-year comparisons in the CPI that we're going to see on the energy side. Politicians are certainly trying to play it off as a one-time effect, and that might be the case. But I just see gold as an area that people just kind of want to be in there right now, just as a little bit of a safe haven, especially with risk assets getting a little frothy here. And that's some of the names I'm looking at. Again, we'll expand on this on the site, but now we're going to pass it on to Sean, who's got some great ideas for you here.
All right, guys. So some of these are long, some of these are short. So the first one, now this is really interesting. So we've had, when I talk about like a sector that was strong and now is in either a stealth or almost like its own full bear market, would be the fiber optic sector. And we've seen a couple of these companies miss and announce some poor results, but any technology company that sells gear is just not going to have an earnings beat every single quarter. They're just going to stumble once in a while, so they can have a great year and they're going to have some tough periods. But what's really interesting about Neon Photonics, NPTN, is that they had a terrible guide. I think they lowered their guide by 25 to 30%. And if you look at the stock, I mean, it had a massive bounce off $7. It was down a little bit today. Anyway, but I'm just saying, when I see a stock that produces terrible news and it turns and goes higher, that's something that I'm going to pay attention to. I also think, just from a broader perspective, I think the Neon Photonics guide could easily be sort of the short-term bottom for the group. So moving on. So AMD, I actually caught a short on the site already on this. I don't know, it's 15-20%. I kind of think, I want this to go a little bit higher. The bottom line is anywhere at 1450 or higher, I'm interested in the short. I'll have a stop in place, but to me, this is a toppy chart. Looks like it's rolling over. And yeah, I think the stock is trading at a, more richly. It's largely ridden the back of NVIDIA, which might be my next one. Okay, there we go. So NVIDIA, now I want to short it slightly higher, kind of anything at 105 above, I like to short. Now it's interesting, Gav's price where he likes to get long is basically the first area where I want to cover, 95. And to me, it's a short, 105 plus, and it's a cover at 95 until it proves me different. I do think the stock will actually go quite a bit lower. So the one area where I would disagree with Gavin on is that NVIDIA is not a software company, it's a chip company, and chip companies tend to trade at chip valuations, and it's not trading at a chip valuation. So I think that will come to pass, and again, all it would take is for them to miss 1 or 2 quarters, and you could probably see this thing in the 55 to 65 area fairly easily. I mean, put it this way: you get a stumble, and this is going to have a scary drop. So I definitely would not want to hold it, I don't think, in front of earnings prints. PCTY, this is Paylocity. Now, I have this stock up here for a very specific reason. They had some negativity in front of their earnings result. They actually popped a good quarter. And what has been typically the response to a company that has an earnings beat and the stock gaps up? Almost every single one of those companies has gone down. This is actually a very, very rare chart that post the earnings gap higher, it didn't sell off very much. And it's either held or kept going higher. And I do like this. This is a nice mid-cap growth company. I like it long-term. But I think there's even some short-term value, and I like the earnings reaction. Now here's one. This is a stock I didn't like before that a lot of people used to love, and I thought it was a short, and I was right. And at this point, I don't think I want to short PanW anymore. This is Palo Alto Networks. Probably my favorite subsector for technology is the security sector. I think it's very interesting that Gavin's mentioning blockchain. He's right. There's a ton of really interesting companies. They're all private. But there are some plays from the bigger security companies. Maybe they could buy some of that technology or acquire some people. And I would say if a company's going to go out and acquire really good, interesting technology, Palo Alto Networks is probably in the best position to be an acquirer in the space. And I think they might do that. But this is one that I'm like, I just got to find a point and buy it. And I even like call options on this longer term. Let's see how many. Twilio we've talked about. I've had mixed success on this stock. I've actually had good trading success. I've hit a lot of these buy points, but it's been a bad hold for me. So pretty much any of the position I've carried from, let's say, 35-ish is pretty much down, but I've caught a bunch of trades on it. But this is one, I really like this chart. So notice this big overhead cloud that it's taken, 2, 3, 4 months to clear. Well, now it's just starting to kind of peak out and maybe get to the point where it's going to cross and be above a thin, wispy cloud. Again, this is a chart tool I like, but they had a really good report. I mean, just the simple fact is Twilio had a really nice beat and raise and has gotten nothing out of it. This has been more the typical reaction. It had a little bit of a pop after earnings and then maybe held for a day or two, and it's been algo drift lower pretty much ever since. I don't know how many. Oh, this is why I have data here. I do like data, although I'm not buying any right here. It wouldn't take me too much to get. I'm probably going to wait for maybe something closer to the 5 EMA. But here, this is a great example. They had a great earnings report, and it was an earnings report that shocked everybody. And look at that gap up, but then look what the stock's done. I mean, it's basically filled the gap. So actually, this is an interesting long from a number of areas. But I actually don't love this chart because to me, this chart's really a coin toss. But I do like the company. I like the valuation. And I do think they're kind of past the worst of their earnings reports. And then Cray, I'm just mentioning again, this was on my last webinar I did. And if you notice, I mentioned this right before Cray had a really beautiful spike up. This is also notable because Neon Photonics acted very well after an earnings miss. Cray acted very well after an earnings miss. I'm seeing some questions here, but the bottom line is Cray basically had an earnings miss. Stock popped. Again, it's been drifting lower, but it wouldn't take me too much to get long there. I think I just have a couple more. AMBA, just going to mention real quickly. So Gavin talked about NVIDIA. I actually think AMBA might be kind of a better play. If you want to talk about driverless technology, camera technology, cutting edge kind of video technology and chip innovation, I actually think AMBA is one of the more innovative chip companies out there. I do like this after a long digestive period. And then the last thing I'm going to say too, I don't just do tech. Oil, I'm a big oil bull. And everybody's kind of freaking out on this big oil sell-off. But just look at this. I mean, to me, this is like the most beautiful pullback you can have. It's just ticking the bottom of an upward sloping trend line. There you go. I don't know. I like oil. I'm long oil. I'm going to be long more oil names. Real quickly, I'm going to address one question. EMA is exponential moving average. So that's all that is. Stocks, you can go either have a simple moving average or an exponential moving average. I prefer exponential. And there's one question early on that said, TECHT, what are those stocks who create the most of the returns? I'm not exactly sure what he means. I think he's talking about when I said only roughly 10 stocks have accounted for most of the return of the market. That's basically your FANG stocks, Facebook, Amazon, Netflix, Google. NVIDIA is certainly one of them. Microsoft's another. I kind of call it FANG plus 4 to 5. But very, very small number of stocks. And then in the last quarter, the narrow leadership in the finance sector has accounted for most of the upside in the market. And with that, whoever's next, fire away.
All right. With that, we're basically coming to the end of our webinar here. Just one quick question. Sean, thank you very much for addressing your two and great ideas. Yeah, I'm sure we'll have fun debating the NVIDIA on the site for the next few months and stuff. So that'll be interesting to see how that rolls out. And also, for what it's worth, I totally agree with you on oil. I've been holding the USO for a while and just kind of building on that. But just one quick question that I was going to pass along to Brett to answer. Then we've got a couple others that we'll take care of due to time constraints. I know we've kept you guys here a lot longer than we said we would. We apologize. This is a new format for us. So, Brett, if you wanted to address, somebody was asking what is the best way to hedge the European elections?
Yeah, no, I see it. I mean, I think that the question is actually saying, what large money managers, what are they pressuring right now? What's being driven or distorted by the looming presence of this factor, so that it probably is being mispriced if it goes the right way. And I think that it's kind of like, where's that snapback? I think the most direct place is going to be something that for a lot of people is difficult to trade. The big trade setting up with some of the largest, more aggressive fund managers who are looking at playing some allocation toward making something if Le Pen wins. I've noticed that theme is basically a spread trade in terms of peripheral European interest rates. So, and obviously the French bond market. So shorting French bonds, shorting Italian bonds, shorting Spanish bonds, and maybe holding that against German bonds, or maybe a basket of debt, including Germany, the United States, and Japan. So it's been, at this point, a bond market story. And I think one of the interesting questions is it also a euro story? And I don't really know the answer to that. I suspect that there's a lot of dampening in the euro chart that's based on this in some form or another. It's difficult to track directly how the flows are happening. But I think that probably the night after the election, if it's Macron, the euro's gapping up quite a ways. But right now, so far, where we can see direct evidence of hedging, it's been in the bond market in peripheral Europe and France.
Yeah, I mean, I would agree. That's one of the reasons why I like the long euro. I mean, I think that this just whips back. I think a lot of people have been short the euro on the idea that it's just going to fall apart. And it's not out of the woods by any stretch, but I just think that the fear of 2017 has been overdone. The other thing that I'd probably add too, Brett, is I would assume credit default spreads are, the CDS is also being bought. Which is why I'm curious to take a look when I was going through with my part of the presentation to find the difference between 2003 versus 2014. With 2003, it looks like it's going to be a lot harder to hedge out of that. And I'm just kind of curious how well that's known in the markets and what sort of impact that could have. That's going to be something that I'll be doing a little research on. But I don't know, guys. Do you guys have anything else to add at this point?
I don't.
Well, that about does it for me.
All right. Well, we'd like
I'd
to thank everybody for joining. What's up, Brett?
No, I was just going to say, like Gav said, if we see any other questions, if you guys want to throw them up, you can email us, and we'll get back to you, and we'll probably address them on the site.
Yeah. For time constraints here, we'll address them on the site. There'll also be copies of the webinar available tomorrow. Mike Midland is also available. He's a little under the weather with the cold today, so he's not talking. Otherwise, he would have been the MC for us. But he is available for any questions that you may have with regards to this webinar, trading ideas, or anything else. But we definitely would like to thank everybody for joining us this afternoon. We realize we're up against the NCAA tournament, so we appreciate you guys cutting out a little bit of your time for us. Everybody have a good day, and we'll talk to you guys later. Bye-bye.
Thanks, all.
Yeah, thanks, guys.